Hi, this is Matthew Cratter from Trader University. And in this video, I want to talk about a stock that could be the next GE, the next General Electric. And if you lost money in General Electric, you're going to definitely want to watch this whole video so the same thing doesn't happen to you again. I get a lot of questions about these sort of high dividend yield stocks. And what I have here is a list of the Dow 30 stocks. And I have the highest dividend yield stocks in that index. So I have IBM, I have Verizon, ExxonMobil are the ones that really stand out here. This is not the stock that I'll be talking about, but I want to tell you about this as a general principle. Now, the U.S. 10-year note, which is government bond, is currently at about 2.5%. So my general rule of thumb is you don't want to own a stock that has a dividend yield that is higher than 1.5% above the 10-year Treasury note. So the 10-year Treasury note, call it 2.5%. So if a stock is trading 2.5% plus 1.5% or above a 4% dividend yield, that means usually means there's something wrong with it. Either there's something wrong with the company or there's something wrong with the industry. So for example, IBM, Verizon, ExxonMobil. IBM is one of those situations where it's just had declining revenues over the last 4 years. It's kind of a big giant company that's lost its way. Verizon is similar, stagnant revenues over the last 4 years. It's still revenues hovering around 130 billion. And ExxonMobil, I spoke about it in another YouTube video. This is sort of a stock that is eating itself as it pumps all the oil out of the ground and is unable to replace it at an economic cost. So I would encourage people, it's very tempting to be attracted to these high dividend yield stocks, especially when they're blue chips and everyone knows the names, and our grandparents made a lot of money on these stocks. But you should definitely, unless you know a lot about the company, you should steer clear in this sort of low interest rate environment. Now, the stock I'm going to be talking about is a dividend S&P 500 Dividend Aristocrat. And these are stocks people like to invest in. I wrote a book about investing in these, so I'm certainly not against that. But this is a stock that made our grandparents a lot of money as well. It's a Dividend Aristocrat, which means that it's been raising its dividend every single year for the last at least 25 years. So the stock I'm talking about is AT&T. A lot of you guys own it. I've been getting a lot of questions about it. And it has an extraordinarily high dividend yield. If we scroll down here on Yahoo Finance, we'll see the dividend yield based on they just hiked their dividend payout in December, and the dividend yield based on that new payout annualized is 6.5%. So we were looking at 4% dividend yields. This is an extremely high dividend yield. And if you think you're getting something for free by buying this, you should be very worried because you almost certainly are not. General Electric traded similarly. It traded at a fairly high dividend yield. I think it got up to 6 or 7% if I remember correctly. When you see a stock like this that's trading at such a high dividend yield, it means that the market is pricing in a dividend cut. Or the company is so leveraged, has so much debt, that there's a chance of the stock going down quite a bit if something goes wrong. So nothing against AT&T, but the real problem is they've been pursuing a business strategy which doesn't make any sense, and while doing it, they've been loading themselves with tons and tons and tons of debt. So if we look at their acquisitions over the last few years, the two really big ones were Time Warner in 2016, or actually it closed last year. The Time Warner acquisition and DirecTV. Time Warner for $85 billion, DirecTV for almost $49 billion. Now, these are, in my humble opinion, these are not great acquisitions. DirecTV is sort of a declining business. The sort of 20s and 30s demographic has nothing to do with it. And personally, I'd much rather watch something like YouTube or Apple TV or something like that. Same with Time Warner. They do have some interesting old movies and properties, maybe the Cartoon Network. But they paid an enormous price for each of these. And they also took on a lot of debt in the process. So if we look at AT&T's balance sheet, they've gone, and we're going to be looking at their long-term debt here. I'm right at the balance sheet here, long-term debt. And over the last few years, it's gone from $76 billion to $118 billion. Now it's at $166 billion. Now, this doesn't even take into account deferred tax liabilities, other non-current liabilities like pensions, et cetera, et cetera. But at $166 billion in debt, this is a highly leveraged company. And they're a company that's also losing market share. They're losing market share to Verizon. Verizon just has a better cellular network. And as they're losing customers, they're sort of trying to figure out what to do. And their strategy has been, rather than, Verizon is really just focused on making their cell network just better and better and better and put money into that. AT&T has done these kind of crazy acquisitions and piled on the debt in the meantime. So if we go look at AT&T's cash flow, statement of cash flows, we'll see that it's been paying a dividend of $13 billion. Now, it has free cash flow over the last 12 months of 22, call it 23 billion, which is fairly good free cash flow. But this is a company that has to continually invest in its network to stay competitive. And instead of doing that, it's been buying these sort of dated legacy media properties like Time Warner, DirecTV. These are declining businesses. And so I think their business strategy is just completely wrong. Losing market share to Verizon, very high dividend yield that's being pricing in a dividend cut. So I would, people who are fairly dividend yield hungry these days because of low interest rates. But this is one I would steer clear of unless you have a really deep understanding of the business. And we've seen Verizon really outperforming. Verizon's not really one I would buy either for the same high capex reasons, but Verizon has really been outperforming AT&T over the last 12 months. If you enjoyed this video, please subscribe to my channel. And if you've listened this far and you'd like to learn more about good ways to make money in the stock market, check out my courses at Trader University, and I'll put a link in the description notes below. I've got a bunch of courses here, but the one that's probably most relevant for what we've been talking about today, financial statement analysis. Financial statement analysis really is the language of business, as Warren Buffett is fond of saying. And if you become familiar with the financial statements, there's a lot you can do. A lot of worlds really open up. In addition, I have other courses on swing trading with options, price action trading, and then I have my flagship course, Learn to Trade Stocks Like a Pro. So I would encourage you to go to the website. Just click in the link in the description notes below, and you can check out the courses there. And if you are interested, you can click join, and you'll be taken to this page, and you'll see I'm offering these courses, unlimited access to all my courses and books for just $125 for 30 days access. That's sort of monthly tuition. But because you saw this on YouTube, I'd like to give you a special discount code. So you click on there and you go down here where it says have a coupon code, and I want you to type in YouTube 2019. Click update, and that will lower your monthly tuition to just $99. So I'd encourage you, sign up for just 1 month if you want. You can cancel after 30 days. You just pay every 30 days. You could watch all the courses in 30 days and then just cancel after that. So I think it's a very good value for the kind of quality lessons that I provide. Thanks a lot for listening to this video on YouTube. Be sure to check out my other videos. Please subscribe. And if you have any questions, I'd love to hear them. Leave them in the comment notes below. And I'll see you in the next video.